Hey, Perry Jeffries here, the entrepreneur, CFO, president, and financial advisor with Diamond Equity Advisors. Hey, I'm super excited to share this information with you today. Over the next 20 minutes, you will receive probably the most important information of your financial life with respects when it comes to retirement planning and financial planning. So first of all, let me say, one, I commend you. I commend you for taking the time to watch this video. Why? People always make time where they see value. And the fact that you're watching this video means that you see value not only in your financial freedom and success, but also of you and your family. So for that, I commend you. So with no further ado, let's get into this information here. So bear with me 1 second while I share my screen with you. Outstanding. So welcome to the Diamond Equity Advisors Bucket Plan Financial Planning presentation. Now, we're going to move quickly. So I want to make sure that you have pen and paper handy because again, this information is going to be extremely beneficial to you, not only you, but also to you and your family. All right, let's get it moving. So if you want to follow us on social media, you can find me on just about every medium. You can find me on Facebook at VECFO, Perry Jeffries on LinkedIn, Instagram, YouTube, Twitter, or you can just Google Perry Jeffries. I'll pop up there on the Entrepreneur CFO. So little background on myself, and I'm not going to spend a lot of time here because this video is not about me, it's about you. But I believe it's extremely important for you to know the messenger who's delivering the message today. So a little background on myself here. I've been in the industry, the financial service industry, helping clients just like you for over 15 years. I've held positions with a couple Fortune 500 companies. I currently hold my Series 7, Series 66, and Life Health and Annuities license. So with the 7, obviously I'm a securities / stockbroker, if you will. With the Series 66, I'm an investment advisor. And on the life and health and annuity side, I can offer annuities and life insurance, term, whole life, things of that nature. I have through the College of Financial Planning what's called a CRPC, which means I'm a Chartered Retirement Planning Counselor. So by their standard, I'm a retirement planning expert. I also have what's called a CPFA through the National Association of Plan Advisors, so a Certified Pension Fiduciary Advisor. So in this new investment client, it's very important for you as a client to understand whether or not your advisor is a fiduciary or not. So I'm not going to go through it on this presentation here, but if you were to Google the DOL fiduciary rule with respects to how advisors should be working with clients moving forward, it'll give you a lot of detail on that. So nonetheless, I'm a certified pension fiduciary advisor, which means when it comes to retirement plans, 401ks, pension plans, not only can I install them, but I can help manage them and give advice on them. All right. Now, outside of the investment realm, I'm also a ambassador to Daymond John. If you remember him from FUBU, the People's Shark on Shark Tank. I'm one of his ambassadors with his Rise and Grind book being released. And something I'm extremely proud of is I'm a member of the global leadership team of John Maxwell. So if you're familiar with John Maxwell, maybe the leading authority with respects when it comes to leadership training, author of 21 Irrefutable Laws of Leadership, 15 Invaluable Laws of Growth. I'm a certified John Maxwell speaker and coach. So just a little aside, something I believe is really important is to not only when you're working with someone, but to make sure that you're always becoming strong with respects to leadership. Because in every role, regardless if you're a parent, an advisor, a coach, you need to be a strong leader. Okay. So moving right along, that's all about me. Let's get to you. So grab your pen and paper. I want you to write this down with respects to what keeps you up at night. So super important that you write this down. Now, as you're writing this down, does anything on my screen keep you up at night? Retirement, cash flow, taxes, succession planning. How are you going to pass your income or your assets on to your spouse or to your children? College funding, healthcare, long-term care. They say healthcare and long-term care are the two variables which may actually destroy someone's retirement in their retirement years because we don't know what those costs are going to look like. Are you concerned about running out of money? How about death? So whether what keeps you up at night shows up on this list or not, make sure you write these down, because we want to make sure that we get the answers to those questions for you or concerns that you have. So before we get into the meat of the presentation, we need to establish a solid foundation. So to establish a solid foundation, we need to understand what is the money cycle. So what is the money cycle? Well, there's 3 phases to it. The first phase is the accumulation phase. So this is the phase where you're the hunter and the gatherer, where you're trying to accumulate your assets. Now that could be different things for different people. Maybe that's investing in your 401k. Maybe that's buying rental property. Maybe that's growing your business. But during this phase, you're trying to accumulate wealth. You're trying to accumulate your nest egg. Your next phase to the money cycle is the preservation cycle. So, after you've accumulated your assets, now it's time to preserve them. How do you protect them? Now that you've built that nest egg, how do you protect it? And then last, you have your distribution phase of the money cycle. This is where you start to distribute those assets in the form of income. So you've accumulated, you protected. Now it's time for you to live off that money in the form of income, if you will. Okay. So these are your 3 phases: accumulation, preservation, and distribution phase. Now, a common mistake that people make is they'll go directly from the accumulation phase to the distribution phase. So let's take a pause right here and give you an example of what I mean by that. So years ago, I used to work with a lot of clients over at General Motors, and very good people, hardworking people. And I would sit down with them to help them with their financial goals and their retirement planning. And I would notice a lot of times that inside their 401k, they would have like 100% General Motors stock. And I would say to them, Mr. and Mrs. Client, it's not very prudent for you to have a concentrated position like that inside your retirement account. And their response to me, don't worry about it, Perry. General Motors has been around forever. I've been working here 30, 40 years. I'm not worried about the stock. Well, do y'all remember 2007 and 2009 when the markets crashed? I sure do. During that same time frame is when General Motors had to file bankruptcy. So for those individuals who had those concentrated positions inside their 401k with one stock, guess what happened? They lost almost all of their retirement. Thank goodness they still had pension plans, but losing that majority, a large majority of your retirement changed their lifestyle. So imagine if you were about to retire that year or 5 years out. Your retirement has kind of gone up in smoke now, at least what you thought it was going to be. That's because they never went to the preservation phase. As you get closer to retirement, you have to start thinking about how you're going to protect the nest egg that you have. So that's why it's really important to make sure you go through all 3 phases and don't just skip from accumulation to distribution. That makes sense? Perfect. There's going to be a test on this at the end, so make sure you remember that. Now, some of the biggest dangers you face in retirement. So obviously, one of the biggest dangers you may face is market risk. So again, regardless of how you're accumulating your assets, the markets go up and down, the stock market, the real estate market. So again, when it comes to you retiring and creating and building that nest egg, you have to be conscious of whether or not the markets are going up and down and how to protect against that, because that could impact you tremendously. Again, imagine if you were retiring between 2007 and 2009, when the market was cut almost completely in half in the course of like 2 years. How does that impact your retirement? The next thing that may impact your retirement is interest rate risk. So yeah, we think about interest rates as far as, car loans, mortgages, how we borrow money, credit cards, right? But how interest rate can impact you during retirement is this way. Typically, when you go to retire, you should be going from, a risky asset class such as stocks or equities to a less risky asset class like bonds or fixed income. Well, in doing that, you need to understand this. Interest rates, bonds have an inverse relationship to interest rates. As interest rates go up, bond values go down. So if you're in your retirement phase and you're starting to distribute your money and you have a large allocation of your funds in fixed income or bonds, that can have a huge impact on you when the interest rates start to go up, because those values could go down, right? So that's interest rate risk. But there's one other danger you need to think about with respect to retirement that a lot of us aren't familiar with, and that is sequence of returns risk. Write this down. Of the 3, market risk, interest rate risk, and sequence of returns risk, sequence of returns risk may be the most dangerous. And I'll ask you this question. Have you ever heard of it? Better yet, if you have a financial advisor, have they ever explained it to you? As financial advisors, being in the industry as long as I have, sometimes we do a poor job. Matter of fact, a horrible job explaining this to clients until it's too late. So we need to make sure that clients understand this well before they get into retirement. So let me give you guys an illustration here. Let me ask you a question. If I had two portfolios, one on my left hand, one on my right hand, and one was, I told you one was earning 10.5% rate of return, and the other one's earning 9.6% rate of return. Which one would you take? Right, that's a loaded question. Who's not going to take the 10.5? Well, let me show you an example here. Let's look at Mr. Smith and Miss Jones. Mr. Smith and Miss Jones have the exact same account. They both have $100,000. Their accounts are both 60% stock, 40% bond, which in my world, we consider that a balanced portfolio. And they're both taking out the exact same amount of money per year as income in their distribution phase. So they're in the distribution phase. So they're both taking out $5,000 of the $100,000 that they have. Now, at taking $5,000, that is fair under financial planning guidelines. That is a reasonable amount of money to take out per year, 5% per year, and not really run the risk of running out of money, unless you're hit with sequence of returns risk. So let's look at this here. Mr. Smith retires in 1969 with $100,000. He starts taking out $5,000 a year. And lo and behold, by 1988, 1989, his account is completely depleted. He's at zero, which means his lifestyle has completely changed. Hopefully he has some other monies or other income coming in, but his portfolio went from $100,000 to zero. Miss Jones, on the other hand, retired in 1979 with the exact same portfolio. And she's able to take money out here for over 30 years. And she started out with 100,000 and her account was up to 600,000. So you may ask, how is that even possible? Well, take a look at this and see if you can tell me why. Now, before you tell me, oh, well, Mr. Smith should have got out the market or Miss Jones just retired better. No, neither one did anything wrong. And they have the exact same account. So let's look at a year here. Let's look at 1987, for example. 1987, Mr. Smith's account earned 5.7. 1997, Miss Jones' account earned 5.7. So they're invested in the same portfolio with very drastic and different outcomes. Well, what happened? Simply this. What happened was Mr. Smith started taking money out of his account, and just so happened that year the market was down 2.6%. Not 10, not 20, not 30. His portfolio was down 2.6%. Not bad at all. And he had a couple other negative years. And because those negative years happened at the beginning of his distribution phase, Mr. Smith ran out of money. So we don't have a crystal ball to determine when we should retire. We just know when we want to retire and how much money we want to start receiving. So the sequence returns risk, the best way I learned to explain it is imagine this. Imagine you were going to the water fountain and you were filling the water fountain up, filling your cup up with water on the front end. So you're taking your income on the front end, but you don't realize there's a hole in the back. So as you're filling your water up on the front end, there's a hole in the back and water is leaking out the back end. Well, what happens is that water jug is going to get depleted a lot quicker than you would like it to, because you're taking out that money on the front end, but also too money is leaking out on the back end. So that's sequence of returns risk. So you may be asking like, oh my God, Perry, how do you defend against that? Great question, because again, Mr. Smith didn't do anything different than Mrs. Jones. Just the market was negative on the front part of his retirement. His account was negative on the first part of his retirement. With Miss Jones, hers was negative on the back end. Okay, so let's moving right along here. So sequence of returns risk. If your advisor has not explained this to you, you need to have a conversation with them. Another thing that may impact you during retirement is understanding the new math. Now, those who know me know that I have a degree in math with a minor in science. So my degree is in mathematics with a minor in biology. So I love math. And why do I love math? because math is definite. 2 plus 2 is 4 in any language, right? But there's a difference between math and investment math. So traditional math and investment math. And let me kind of show you why. So scenario here, you have $100,000 principal, right? $100,000 and you're investing it. And let's say that the market goes down 30%. When you start off with 100,000, market goes down 30%. How much do you have left? You need your calculator? Okay. For those who are pretty decent in math, 30% from 100,000 means that you are left with $70,000. That's correct. So my question to you is this: how much return in the market is needed to get back to your original balance of 100,000? So you start off with 100,000, market takes your account down to 70. How much return, percentage return, do you need to get in the market to get back to 100,000? I'll let you think about that for a second. Okay. Most people initially would say 30%. I lost 30%. If I get 30% back, I get back to even, right? Absolutely correct. Incorrect. So what I mean by that, and you're like, hold on, Perry, you actually need 43% return is needed to get you back to 100%. So start off with 100,000, down 30% to 70,000. 30% of 70,000 is just 21, which only gets you back to 91, not your 100. You actually need a 43% return to get back to where you started. Whew. So think about what that means. The gains are great when we're making them, but what happens if the gains are not good, if there's a correction in the market? It's going to take you longer to get back just to where you started, let alone continue to grow the principal. So quick question for you. What if you started off with 100,000, you lost 50%? That's right. It's going to take you 100% return just to get back to where you started. So with respects to investing, the gains are great, but you have to be able to protect against the downside, because it may take you longer just to get back to where you started because of the losses. You need to understand the new math. Now that I've probably frightened you to death, and I apologize for that, how do you protect against these things? Hence the bucket plan, right? So the bucket plan is a strategy that we use to help mitigate and reduce some of those uncertainties, okay? So the way we do that is we take someone's portfolio, so whether it's real estate or 401k or whatever the case may be, and we look at them in 3 separate buckets: the now bucket, the soon bucket, and the later on bucket. In the now bucket, what we're going to do is buy the first year of a particular goal. So let's say you want to retire. We're going to have the first 12 months of income in the now bucket. It's going to be in something very safe and very liquid. We're also going to put our emergency funds in there, any type of planned expenses like going on vacation, things of that nature. That's going to go in the now bucket. So we bought that first year, no worries. We know it is next year, current year that we're in right now, 2018. If that's the case, we have monies allocated for this year. Then we have the soon bucket. So this is money that we're going to need, or assets we're going to need from year 2 to year 10. Now understand, year 2 to year 10, that's not a long period of time. So because of that, we want to try to protect those assets. So we want to have those assets invested in something that's more conservative, that's keeping up with inflation. And this is considered our first phase of income. So with this particular bucket right here, we want to make sure that we're, allocating monies for the next 10 years of income that are not going to be 100% subject to market risk. And also too, with respect to sequence of returns risk, we take that danger off the table by having these dollars invested in such a way that when we're using these in these first 2 to 10 years of income, we're not subject to the market. Okay, great. And then we have our later on bucket. With our later on bucket, this is where dollars are going to be allocated, where we can have them invested in the market. Why? Because it's over a long term, 10 plus years. And what have we known and learned about the market that's tried and true? It goes up and down, but it trends upward. Something an advisor told me years ago when I first got into the business 15 years ago. He said, Perry, what you're going to learn about the market is this, that the highs are permanent and the lows are temporary. So understand that the market is going to go down. but then it's going to go up. It's going to stay there, then it's going to go down, then it's going to go up. So that's what we've learned about that. So if we have time on our side, then we have a better chance of being able to grow that money. But while the market is fluctuating in that later bucket, we know that in the soon and now bucket, we're not subject to those same risks. Okay, so we buy the time frame. So I'm going to test you on this later. Now, soon, and later buckets. Great. Now, some mistakes that sometimes investors make. I'm going to go through a lot of this, but a lot of times investors make the mistake of buying low, selling high, panicking during times of volatility, lumping all of your investments together without separating the money versus what you need now versus what you need later. We're not going to go into that. You know why? Because you're going to have a sound investment strategy where it's going to take the emotion out of the equation. So when you're working with a financial advisor, the goal of that financial advisor is to help you make logical decisions in time of high emotion. A logical sounding board in time of high emotion. Also, too, if you have a plan, then you're not worried about fluctuating too much because you have a plan to address those potential dangers of fluctuation. Okay, this next slide right here is super important. So if you need to sharpen your pencil, do it now, or get you a nice fresh pen and a new sheet of paper, because this is going to be really impactful. So now that we've determined that we need to have a bucket plan and allocate our monies in a now, soon, and later bucket, now what type of accounts do you have? So let me ask you this. And I had an advisor asking me this some time ago, and it's always stuck with me. He said, Perry, are all accounts created equal? I said, no. He said, well, if you had $1 million in a 401k, $1 million in a cash value whole life policy, and $1 million in savings, which one is worth more? I'll ask you the same question. You have $1 million in a 401k, $1 million in a cash value whole life policy, $1 million in your savings, which one is worth more to you as the client? I had to think about that one too. So being the advisor, so many years dealing with things on the security side like stocks, bonds, and whatnot, and mutual funds, I initially leaned towards the 401k. How about you? Because I'm thinking the 401k, I have the opportunity to grow the money. And then the advisor asked me a question that I knew exactly where he was going. He said, well, what's net to the client? Well, understanding if you're set up like most people who have a 401k, the majority of those dollars are probably pre-tax dollars, which means that $1 million is not truly $1 million. After taxes, that $1 million is more like $600,000, $700,000, right? How about the $1 million aside the savings account? Well, the savings account is a taxable account, which means that you're getting taxed on the interest of that money. So let's say you're earning a whopping 2% on that $1 million. You're not going to receive all of that 2%. Why? Because those dollars are going to be taxed. Well, how about the cash value policy? Well, the dollars in there grow probably quicker, depending on the company that you're working with, probably faster than, a savings account. Not as probably doesn't grow as much as the 401k, depending on how it's invested, but you're getting some inflation growth in there. Plus those dollars come out tax free. So in that sense, then the cash value policy may be worth more of the three. So when you look at your portfolio, you probably have one of three accounts. You have a taxable account, like your savings account or your online brokerage account or investment account, CDs. You have your tax deferred account. So this is going to be like your 401ks and your IRAs. And you have your tax-free accounts like your cash value insurance policies or your Roth IRAs or your Roth 401ks. So understanding that you have three different kinds of accounts you can have. We have to help you determine what's the best one. Now, the deal is you may want to have a mixture of all three. I'm not saying that one is better, but you need to know the difference between the two. But I will ask you this. The majority of people have a lot of or a majority of their retirement assets in what? 401k plans, pension plans, what's considered tax deferred accounts. So what does tax deferred mean? Tax deferred simply means that you made a agreement with the IRS to say, I'm not going to pay taxes now. I'm going to defer it and pay it later. Nothing wrong with that, except for, do you know what the tax brackets or rates are going to be later on? So let me ask you, Do you think tax brackets and rates are going to be higher or lower when you retire, or for the time that you retire? Well, I would recommend you check out a book. It's called The Power of Zero, How to Get to the 0% Tax Bracket. In that book, it explains some dilemmas that we face in the United States government right now. One of those dilemmas being debt. So, anybody heard of Social Security? Great. When Social Security was first created, it was 42 working individuals paying to 1. So 42 to 1 ratio. That ratio now is closer to a 5 to 1 and quickly approaching a 3 to 1, which means that Social Security is becoming extremely expensive to the government. Well, if the government is in an issue, in a situation where it's having to figure out how to, pay for this debt, one of the quickest, most efficient ways to do that is what? To raise taxes. So if tax rates are higher later on in your retirement years than they are right now, there's a chance that you're going to end up paying more on your money when you take it out during retirement, during distribution phase, than you would have on the front end. Something to be aware of, because that could be very impactful to your retirement, because at the end of the day, your retirement is not based upon your gross, it's based upon your net. And since we're on the topic of Social Security, can Social Security be taxed? Absolutely it can. What determines if your Social Security can be taxed? What's called your provisional income, which is an equation where they look at 50% of your Social Security plus any money that you're taking from your tax deferred accounts, your 401ks, your IRAs, interest you're earning from bonds and things of that nature. And if you pass a certain threshold, then anywhere between 50 to 80% of your Social Security could be taxed. Wow. That doesn't seem fair, being that it seems like the money was taken out of your paycheck all of those years, and now 50 to 85% of it could be subject to ordinary income tax. So understand that when you retire, ordinary income tax, you may be, the idea when the 401ks were first started, the idea was that you were going to be in a different tax bracket, a lower tax bracket during your retirement years. Well, I don't know about you. I don't want to live on less money in retirement than I'm living on right now. I want to maintain the same quality of life. Well, if that's the case, you could be paying more on your money down the road than you're paying on it right now in taxes. So it's vitally important to make sure that you have a good mixture of 3 different accounts: taxable, tax deferred, and tax free. All right, moving right along. So what's the process? All right, we're near the end, group. So this is going to be your test. It's an open book test. Hope you've been taking some really good notes. First step to the process is to educate you on the money cycle. So what is the money cycle? You got it. Accumulation, preservation, distribution. Perfect. Educate you on what the bucket plan is. A bucket plan is a way for us to mitigate and reduce risk to potential dangers during retirement. And that's set up in a now, soon, and later bucket, because we're buying those time frames. The next step in the process of completing a plan for you is we do what's called an asset questionnaire. So we get an idea of all of your assets, all of your assets, your liabilities, and we get that in one place so we can see what your net worth is and how you're positioned currently. Then we complete an income gap assessment, which I love to do, because the income gap assessment gives us crystal clarity on what that nest egg number is. How much do we need to put away to be able to, fill the income gap? So this is what you're used to currently making. This is what you have coming in a fixed income. What's left is that gap in the middle. And what do we have to do to fill that gap? Gives you crystal clarity and direction with your financial plan. Do you currently have that right now? Then we get an idea of kind of your risk tolerance. So everybody is different. Some people are aggressive, some people are conservative, some people are moderate. Your plan should be built around your risk tolerance, not the risk tolerance of your friend or the person at the gas station, but based upon your risk tolerance and your specific goals and needs. And then finally, we design a bucket plan for you. So that's the 6-step process, pretty easy. So congratulations, you made it to the end of the presentation. Hope I didn't bore you to death. But as I promised you, this information was going to be extremely, extremely important to with respects to your financial plan and your retirement goals. So I'm glad you made it through. So if you want to contact me, you can always visit diamondequityadvisors.com, right? If you want to go kind of check out our website, but also too, if you saw this presentation and you're like, okay, I need one of those bucket plans, well, feel free to visit me. We'll schedule an appointment to speak to me at mycfo.ask.me.com. So that's www.mycfo.ask.me.com. And you'll be able to get into my calendar for a quick 20-minute consultation and see if it makes sense or is a good fit for us to work with each other. So regardless of who you decide to work with, whether you work with me as your personal CFO or your advisor, you want to make sure you have crystal clarity around your plan. And remember, if it's not a written plan, it's not a plan, okay? If I were to leave you with this, if you were building your dream home from the ground up, dream home, would it make sense to have the architectural drawings before you started building that home? Absolutely it would. So why would you try to create wealth and financial freedom without having a financial plan? So as I leave you with that, again, Perry Jeffries, the Entrepreneur CFO. Be blessed. Much success.